vortex of declining values in commercial real estate is getting wider and increasingly threatening. Imagine you bought a property for $300,000, expecting the investment would not only pay off over time, but also appreciate due to the normal dynamics of the real estate market. Fast forward to 10 years later, you find out that your property has become virtually worthless, even though there's nothing damaged on its structure and your neighborhood has not changed significantly. You're still paying off your mortgage loan, and after prices have plunged seemingly overnight, now you're buried in negative equity and stuck with a property no one seems interested in buying. Well, that's what's happening to commercial real estate owners and investors. But instead of $300,000, we're talking about properties that were initially sold for between $3 to $300 million or more. This year, the commercial real estate market is crashing, and it is crashing hard, with some office and retail buildings losing up to 97% of their value. But many of these buildings are still being paid off by their owners and investors, who are having little choice but to default on their mortgage loans and put thousands of banks that lent them money at risk of total collapse. Can you picture now that the whole financial system is literally hanging by a thread? And that thread is thinning, according to financial experts. A recent analysis by Fitch Ratings predicts that the ongoing commercial real estate crash will wipe out more property value than the financial crisis of 2008. More ominously, Fitch believes any recovery from this crash will be slower than the rebound from 2008, and the gains will be lower. Analysts say that the term lost value doesn't even fully capture the current landscape's reality. As noted by James Carlini, a financial strategist and president of Carlini & Associates, this seems more like a vortex of declining values. He argues that the market is being plagued by a reverse of musical chairs dynamic. The pandemic has fundamentally changed the way businesses operate. For retailers, declining foot traffic at physical locations, lost sales, and higher operational costs resulted in mass store closings, increasing the square footage of empty retail space. Meanwhile, in the office sector, companies identified that a segment of their workforce could operate permanently from home, which created a significant bifurcation. About 35% of office employees have started to work remotely, leading the demand for leased office space in both downtown and suburban locations to drastically shrink over the past 4 years. As a result, the surplus of vacant commercial space and dwindling demand has sparked a reverse of musical chairs effect. Carlini explained, buildings with low occupancy today risk even lower occupancy rates as leases expire and tenants migrate to better, cheaper spaces. Office buildings are being particularly affected by this trend because obsolete buildings are not attracting new tenants. In the third quarter, the rate of empty office spaces hit 20%. That is a 40-year high. Carlini said, that's a problem for more reasons than the casual real estate observer might understand at first glance. First, there is no way any building with a 20% vacancy rate is generating profit or even covering basic expenses like mortgage and insurance. But the underlying issue is that all pieces of commercial real estate's value are tied to how much money it's making. Unlike homes, whose values can be propped up by factors like curb appeal and buyers' emotional attachment, commercial real estate valuation is a pretty cut-and-dried equation where prospective buyers use current rent rolls and revenue receipts as the primary metrics. In other words, a commercial office building or an entire portfolio of commercial properties with vacancy rates of 20% is depreciating every month. While empty stores can be leased by other retail brands, empty office spaces at all buildings are not being reoccupied. The sector has already entered a depression stage. Take, for instance, a suburban Ohio Class B office building that was appraised at $4,252,600 back in 2020. After reassessment, its value plummeted to $2,563,000 in 2023. Now up for a court-ordered sale, the reserve is set for only $1,700,000. The property lost nearly 60% of its value in 4 years. Even more alarming, a New York 23-story, 925,000 square foot building, redesigned by the famed Gensler Architects team, sold for $8.5 million last week. The build was first sold for a whopping, get this, $332 million. This represents a 97% decline. Located at 135 West 50th Street, the office tower was auctioned off by UBS on an auction website called 10X earlier this year. It received just one bid. The building has leased office space for many big companies over the years, such as Zales and Sports Illustrated. But this year, vacancy rates hit 65% as more companies reduce their physical footprint. That's why Fitch doesn't see a commercial real estate bounce back like the one the residential market experienced after the 2008 crisis. Carlini added, "In my view, junk is still junk, even at a discount. Obsolete buildings will not attract tenants unless they undergo significant upgrades to support critical corporate applications." Although some believe that the current decline in real estate values is a temporary phenomenon tied to the pandemic's high vacancy rates, this view is myopic, the strategist stressed. The workforce's permanent bifurcation and the obsolescence of many buildings due to technological advancements suggest a lasting shift, he said. In 2008, conditions were different because most of the distressed assets were single-family homes and condos, which are properties all Americans need to live a normal life. Despite the decline in values, it was only a matter of time before Americans got back on their feet and started buying houses again. On the other hand, the pandemic permanently changed the game. On top of the popularization of out-of-office work, the inflation spike led the Federal Reserve to aggressively raise interest rates, putting restraints on the broader economy. And record high rates have triggered a kick-on effect for commercial office owners and lenders that has been absolutely devastating. Commercial real estate investors and landlords who took out short-term financing at low interest rates to snatch as much commercial property as possible over the past decade are now finding themselves unable to refinance their debt at the same rates. If they want to refinance, they'll have to pay roughly double the interest rates as before. Those who have got dozens, hundreds, or even thousands of commercial real estate assets in a portfolio are completely cooked. More and more landlords are stopping to make interest payments on their commercial real estate mortgage loans because they don't collect enough in rents to pay interest and other costs, nor can they refinance maturing loans given that the building doesn't generate enough in rents to cover interest and other costs. They also cannot get out from under it because prices of older office buildings collapsed by 50%, 60%, 70% or more, with some office towers becoming literally worthless, the property going for just land value. Add that to the fact that even if these semi-vacant office buildings find new tenants, the new tenants will be paying less per square foot than their predecessors. And it becomes easy to see why Fitch is forecasting that commercial property values may never return to their pre-pandemic levels, and even if they do, it'll take a long time for that to happen. The rebound, if there is one, will probably not be strong enough to stave off a tidal wave of commercial debt that's set to mature in the next several years. By some estimates, nearly $3 trillion in commercial debt is set to mature by 2027, and almost $1 billion of that matures in 2024. To sum it up, you have commercial landlords drowning in debt on rental assets that they can't fill, and mortgage lenders holding trillions of dollars in loans on totally toxic assets. When you look at the problem that way, it's easy to understand why everyone from Fitch analysts to the International Monetary Fund is sounding alarm bells about the possibility that the current commercial real estate crash could be worse than 2008. Over the past couple of years, the U.S. banking system is losing its stability due to the rising number of mortgage loan delinquencies and defaults. At large banks, the delinquency rate for office loans has surged to 10.5%, marking a concerning deterioration in commercial lending. They are now just a hair below the worst months during the financial crisis meltdown, when office delinquency rates peaked at 10.7%, and that's according to data by TREP, which tracks and analyzes the sector's latest data. The trend is particularly worrying because we're now learning that several financial institutions in the banking sector have more exposure to the commercial real estate market than they previously stated to their customers. In fact, a data analysis from a finance expert at Florida Atlantic University showed that more than 60 out of the 100 biggest banks in the country are at increased risk of failure due to their commercial real estate exposures. 67 out of 100 big banks have exposure to commercial real estate greater than 300% of their total equity, as reported in their 2024 regulatory data and shown by the U.S. Bank's Exposure to Risk from Commercial Real Estate Screener. Rebel Cole, Ph.D., Lynn Eminent Scholar, Chaired Professor of Finance in FAU's College of Business, stressed, "This is a very serious development for our banking system, as commercial real estate loans are repricing in a high interest rate environment. At the moment, the institutions facing the highest risks are Flagstar Bank and Zion Bank Corporation, according to the screener. Flagstar Bank reported $113 billion in assets, with commercial real estate making up for $51 billion of total assets. Similarly, Zion Bancorp had a total commercial real estate portfolio of 440% of its total equity. The bank reported $87 billion in assets and total CRE assets of $26 billion, but only $5.8 billion in total equity. These are the two largest banks with excessive exposure to commercial real estate, Cole revealed. Both rely heavily on uninsured deposits, which makes them vulnerable to a bank run, similar to what forced regulators to close 3 large banks during spring 2023. Those bank closures have led to concerns about the stability of the U.S. banking system over that long term. Banks with less than $10 billion in total assets are in danger too. Among banks of any size, 1,871 have total CRE exposures greater than 300%. 1,112 have exposures greater than 400%. 551 have exposures greater than 500%, and 243 have exposures greater than 600%. Cole predicted 3 banks have failed in the past year, and now we have several candidates where their exposure to commercial real estate is over 500%. Should another bank fail, it's likely that depositors will pull their money out of these highly exposed banks, which could lead to a banking panic similar to what we saw during spring 2023. If you couldn't see it before, now I bet you can visualize that the thread holding the financial system together is about to break, and break big time. This isn't just a commercial real estate crisis. It's the beginning of the great financial collapse we've all been warned about. We look forward to reading your comments, and thank you very much for watching.